Casey, welcome to the Orbit. It is Monday, June 3rd. This is Income from Options Weekly, where we discuss credit spreads, premium, vol, everything that you need to know as a credit spread trader for both 0DTE and other short durations. SPX, pretty much unchanged right now, but as you can see, didn't start the day that way. It started up near the 5,300 level, got rejected a little bit. Now we're back to about 5,275, which is very close to where we closed on Friday. Speaking of Friday, it was a month end into the close print that, you see some shenanigans a lot of times at the end of the month. There's what looked like to be a really ugly end of the week where the market was testing down below 5,200, got all the way up to this level that we are now, basically in the last 15, 20 minutes of the trading day. Pretty wild stuff. Let's look at it from a volatility perspective, a premium perspective, a levels and expected moves perspective. So right now, for the rest of the day, we are looking at about 21 IV, which is decent. It's a lot higher than we've seen the last couple of weeks. Historically, it's about what you would normally see in 0DTE, neither high nor low. And we are, let's look at the 52.95 to the upside on the expected move right now. That is about near the day's highs, and 52.50 to the downside. Let's look at out to Friday. We have about 14 IV, which is again higher than we've seen the last couple of weeks, but that is not high historically. And that expected move is versus even the movements we've seen in the market the last two trading days. So the expected move to the downside of 52.13 isn't even down to where we were basically at 3 p.m. Eastern on Friday. So be careful about those levels. To the upside, that's 53.30. That makes a lot of sense because that's up near prior highs, and the market has had some trouble getting up through that. But you're going to want to look on that downside and see, for instance, how today plays out. Do we come back to 52.50 today? Because then you're talking about levels down below that at least catch that Friday low. 0DTE trading the rest of the day. Let's forward and premium and vol. So let's go in here. We've got the 52.50 on the short put, the 52.95 on the long call. Let's take that long call up a little bit, catch that 5,300 level. And we are at about slightly bullish leaning, 52.50, 5,300. That risks about 350 to make 150. You can, of course, go wider. And if you wanted to get out to that 4-to-1 risk ratio, you get there pretty quick. That 53.10, 52.40 short call, short put we're looking at right here got you to about that 4-to-1. Going out to the end of the week, again, like what we were saying earlier, is that short put is at the 52.15 level. If you wanted to make sure that you got that down to 5,200, there you have it, about a risking 340 to make 160. That puts your short call up there at the 53.45 level, but at least you're catching that low. You can actually go even lower and make sure that you're below that 5,200 level there. That's about 350 to make 150. Today, obviously, is GME, and it's interesting. It gapped up about 80%, I think, pre-market, and now we are pulling back to about 30%. As you can see, the expected moves even out to, we are looking at Friday's expected move. The IV is 400, and the expected move is 20, which is basically where it was trading on Friday. And on the upper band, it's up to 40, which was around the highs of this morning and pre-market. So the expected move for the rest of the week is either going back to 20, going up to 40. As far as the positioning, this is all based on a Reddit post by Roaring Kitty. And he is long, or at least from the screenshots, he is long a bunch of stock, and he is long a bunch of calls. And those calls are the 20 calls. And from what I saw, his average price is about 6.5, let's call it. So his break even is 26.5 on the majority of his position. And it expires in June. So June, regular monthly expiration. So something to sort of keep in mind is that his break even is only $3 lower than here. And if he is selling stock against those calls, it could compress the stock and bring it back towards his strike. Maybe, he doesn't sell stock below 26, and maybe he's only a seller above 26. But some things to think about from the options market is a lot of options he owns on the 20 strike, and there's going to be a lot of copycats. But again, just as always, if you are trading a stock like this, there's a lot of people that already got taken to the woodshed this morning buying the stock pre-market up near 40. And I don't know why anybody would, but that is not my business what other people do with their money. But if you go back to the 5-year view, you can sort of see how this is not uncommon for these short squeeze type stocks to have that initial move higher. You can see here, come back all the way close to where they launched from, and then sort of do a series of lower highs and higher lows for a while. But it takes a long time in general for all of this to unwind. A lot of people buying calls up here when you can get break evens a couple of dollars away in a stock like this right now, because you're getting to sell to all of these YOLO people up here at super high volatility, and you're getting to buy at lower, less, it's still high, but less volatility near the money. Well, let's just do it. This is the 29.39 call spread. Not that I'm saying to do this trade, but just as an example, you're risking 200 to make 800. So your break even is $2 higher than where the stock is. This is just looking at the 39 call. The 39 call is almost $3. So there are a bunch of people right now, as we speak, paying $3 for the 39 call when you could buy the 29 call and sell the 39 call to them for $2. And your break even would be $11 lower in the stock. So just a quick lesson on spreads versus out of the money calls, in case you needed the reminder.